All right. So hi, everyone, and welcome to the Microstructure Exchange. Today, we're very happy to have Jiaheng Hu presenting a paper on private trading, fee competition, and price discovery at the market close. Jiaheng is happy to be interrupted with questions throughout. So if you have a question throughout, just raise your Zoom hand or unmute yourself and ask your question. And then, of course, also feel free to type questions in the chat. I see that Jiaheng's co-author is here and might be able to handle some of those. So that's all I have. Without further ado, take it away.
Okay, thank you, Josh. Let me share my screen. Okay, I hope that works well. Okay, cool. So thanks a lot for having me. My name is Jiaheng, and I am a student at MIT. So today I'm excited to share with you something that's very interesting and that's happening as the market close of the stock markets in the US. And this is a joint work with Jingxiong Hu from Northwestern Kellogg. He's also a PhD student. This is a very preliminary work. So we very much look forward to all your comments, questions, and critiques as well, especially from a group of people like who are experts in this field, as you guys are in this room. That will be very helpful for us to improve the paper. So whenever you have any comments, please just jump in with it. So without further delay, let me start. Let me start with some motivations. In the US, we know that the market close prices are set by something called the close auctions. These are special events that happen as the market close about 4 p.m. in the afternoon, where the close price is generated. So, well, very soon, I will get into more details about the mechanisms of the close auctions, how it works. But right now, what is interesting is that the biggest changes, New York Stock Exchange and NASDAQ, they are the only providers of the close auctions. So naturally, they became the monopolies of providing the close auctions services. And why that kind of becomes a problem? Because over the past few years, there has been a tremendous boom of these passive investment strategies. And these passive investment strategies really want to trade in the closed auctions. Why? Because they want to trade as close as possible to the market close prices that in order to minimize the tracking errors against whatever benchmarks they're tracking. And because these benchmarks, the net asset values of these benchmarks are computed using the market close prices that are generated in the closed auctions. So there has been a huge demand of trading in the closed auctions and make the closed auction business very profitable for the major exchanges. And as a result, the closed auctions become very expensive because there are only two providers and there are no competitors. How expensive that they are. So starting from 2012 to 2018, within 6 years, the closed auction fee, the base rate in New York Stock Exchange increased by 16%. And in NASDAQ, the base rate increased by 60%. That's a very high increase. So what happens next? Well, since 2016, there are a bunch of investment banks that start to offer this thing called guaranteed close. You can think of this guaranteed close just as one attempt these banks made to kind of cut the business of the closed auctions, which is pretty lucrative, away from the major exchanges. What does the guaranteed close do? Well, I will get into the mechanisms in a few slides, but mainly the guaranteed close guarantees the execution of your order at the close price. If you send an order to the bank will guarantee the execution at the close price, which is generated by the close auctions. So effectively, the banks are free riding on the close price generated by the close auctions held by the exchanges. Why it is attractive? Because the fee at the bank is much lower and it attracts huge volume in the sense that nowadays about a quarter of the volume of the close auction are happening right now in the guaranteed close. You may think that that's not a big deal, that's not a big volume, but because the US stock market is just huge, and closed auction is about 8% of the total volume of the US stock market, so 1/4 of a closed auction, that's already a big volume. Right now, it appears like everything is so great. Guaranteed close is cheaper, and it can guarantee execution. It can provide liquidity, but there are concerns. What are the concerns? The concerns are that the guaranteed close can hurt price discovery. Here, I'm quoting a sentence from a Wall Street Journal article. This is saying that executives at New York Stock Exchange and NASDAQ say that they fear if more of this trading volume moves to the bank's guaranteed close, that will make the closing price less trustworthy, undermining a key pillar of the US stock market. While you will say that, okay, these are New York Stock Exchange and NASDAQ executives, they are the incumbents, they certainly say so. But in fact, there are lots of other market participants that voice the same concerns. So we feel very obligated to study how actually guaranteed close affects the price discovery at market close. And this paper is trying to send a very simple, a very straightforward message, which is that guaranteed close actually improves the informativeness of the market close price. Why is it important? Because market close price itself is very important, and we want it to be informative. Also, if guaranteed close can, on the one hand, reduce the fees, on the other hand, improve the informativeness of the market close price. Now, what does it mean? It means that guaranteed close has the potential to reduce the trading cost of these passive investment vehicles. Now, I just want to show you a picture depicting how basically the growth in the trading activities that are happening in the closed auction as well as the guaranteed close. So these blue bars are the trading volume as a percentage of the total trading volume of the day over the years. So these are SP 500 stocks, and you see that the blue bars are increasing. And right now, the blue bars are already about like 8% to 10% of the total trading volume of over the day. Then the red bars here are the volume that are happening at the guaranteed close. I'm using a label here called off exchange because effectively they are off exchange. And you will see that it's trending up, especially starting from 2016. That's where the Wall Street Journal articles tell us when the bank started this business. And then recently, the guaranteed close takes up almost about like 1/4 of the blue bars. So now I want to spend a little bit of time to discuss or to introduce the mechanisms of the closed auction and guaranteed close. I feel like many people in this room are already very familiar with how closed auction work, but I mean, regardless, let me briefly talk about it. So let me take the closed auction at New York Stock Exchange as an example. How does it work? Starting from 6:30 a.m. in the morning until 3:50 p.m. in the afternoon, you as a trader can send orders to the closed auction. It is just there. You can send orders there, and you can cancel the orders or whenever you want. What are the orders that you can use? As a regular trader, you can mainly use markets on close orders and limit on close orders. These are basically market orders and limit orders, but they happen at the market close. They happen at the market close price or happen in the closed auctions. If we break down the trade volume by these orders, you will find that the market on close orders take up the majority of the trades at the close auction. So 65% of the trades were initiated by market on close orders. This is data from New York Stock Exchange. And then another 15% of the trades are initiated by limit on close orders. And the rest 20% are initiated by something called the closing D orders. These are special orders that the market designated market makers in the exchange use to kind of provide the liquidity and clear the market. And because the market on close orders take up the majority of the trades in the close auction, that's what we will focus on in this paper. And at 4 p.m., that's where the market close. The close auction will generate the close price. How does it generate the close price? The price just basically finds the intersection of the supply and demand curve. It's very simple. And any imbalance in the market on close orders will be absorbed by someone called the designated market makers who sit on the exchange, and their responsibility is just to take in these orders. This feature is very useful for our paper because of these designated market makers, like clearest market, it makes like a one period Kaya model fits really well in this setting. And that's what we will use to kind of organize our thoughts in this paper. How about guaranteed close? Guaranteed close basically guarantees to execute your order at the close price set by the close auctions. How does the bank trade, or how does the bank meet liquidity needs? The bank will meet liquidity needs using its own inventory. And very importantly, there's no execution risk. So this makes guaranteed close kind of different from dark pools. So like the existing theories or work on dark pools cannot be just directly applied in our setting about guaranteed close. That's why I make our paper a little bit more unique. And here I'm just quoting some sentences from what Morgan Stanley sent to its clients. Basically, we look at their client book and see their discussions of how the banks work in this guaranteed close. Morgan Stanley says that we offset the risk by transacting in the market on a principal basis, although we may not choose to perfectly hedge the exposure. What does it mean? It means that the bank does trade on the order flow information that it gets from the orders that are sent to the guaranteed close, and the banks are trying to make a profit of it. But Morgan Stanley also says that the hedging activities may influence the prices you receive on your guaranteed benchmark. Regardless of whether or how we choose to hedge, any resulting profit or loss will accrue to Morgan Stanley. What does this mean? This means that even the bank knows that their trading activities will have an impact on the close prices. And that's what we're getting at. So exactly what is the impact on the close prices? All right, so now let me maybe introduce a little bit who actually trade in the guaranteed close. This is what we know from Goldman Sachs client book. Goldman Sachs said that we offer client facilitation services, which are typically used by clients to obtain liquidity or a guaranteed execution price. It seems that it's mainly those traders who need liquidity that are using these services. Well, in the meantime, the Wall Street Journal article said that some index fund managers, including Vanguard Group and BlackRock, as well as smaller broker-dealers, are also using this service. And if we look at this plot on the right, here I'm basically plotting a snapshot on a particular day of the trade size distribution for a stock. Which stock? That's Apple. That are so basically I take all the trades that happen in the guaranteed close for Apple and then plot the distribution. Well, very soon I will tell you how I measure these trades. But right now, the interesting thing is that you see this distribution. There are many very super large trades, and there are also many very small sized trades. So it is very hard to just distinguish whether these trades are all institutional investors trade, liquidity orders, or some of them are kind of informed, smaller, they're retail traders based on the trade size. So we kind of think that who are using the guaranteed close, not only these are the index funds and ETFs, these passive investment strategies are using liquidity service, but it's also likely some informed traders are mixing in and trying to exploit liquidity provided by the banks, but at a lower fee, at a lower cost. So now I want to show you some facts that suggest that stocks with higher ETF ownership are more heavily traded in the guaranteed close. Although I said that we kind of think that there's a spectrum of traders are trading in the guaranteed close, but we still think that it is the ETFs, index funds, these passive investment strategies who are the main users, who are the drivers of the volumes that are happening in the guaranteed close. So basically here, this is a bean scatter plot. On the x-axis, I am showing you for each stock, I compute the fraction of its outstanding shares who are held by the ETFs, which are held by the ETFs. And then on the y-axis, I'm showing you basically the fraction of the close price volume. What is the close price volume? Basically, that's all the trading volume that are executed at the close price. So I'm showing you the fraction of the close price volume taken up by the guaranteed close volume. So you see there's a very nice linear relationship. We controlled for stock size, volatility, these other observables for this plot. Next, here's a summary of what we do. Basically, we provide empirical evidence that guaranteed close improves the close price informativeness. And our strategy is to use New York Stock Exchange fee cut as a quasi-experiment. And then we try to build a model to rationalize the empirical results and conduct welfare analysis. I have to say that our current model is very stylized, so we are very open to your opinions and feed comments on how to improve the model. But the main purpose of the model, it is not like a pure theoretical exercise. The main purpose of the model is trying to rationalize the empirical findings that we get. So in the model, there are two venues. There's one exchange who holds the closed auction business, and there's one bank. And there's only one price, which is the close price that all the trades are happening. The transaction fee at the bank is lower than the transaction fee at the exchange. But the bank trades strategically in the exchange after observing the order flows. And what we find based on this model is that the informativeness of market close price improves in the trading volume at the bank, meaning that if a stock has more trading volume happening at the guaranteed close, then the informativeness of the close price, market close price of this stock will be better. And we also have some findings about the welfares. We find that informed traders lose from the bank's guaranteed close service, but there's some mixed results on uninformed traders. They can be both better off or worse off depending on parameter restrictions. Our results have very good implications or important implications for nowadays US brokerage industry. Why is that? Because in nowadays US brokerage industry, there are a group of basically brokers like Robinhood, these e-brokers, who charge you like zero commission fee. It's super cheap to trade with them, but the downside is that they will sell your data, your order flow data to Citadel to let Citadel trade on the data. And the combination of e-brokers like Robinhood and like Citadel, who trade on order flow information, really resembles the guaranteed close in our setting. In our setting, it's the same. The bank charges you zero commission fee, but when you trade with the bank will exploit your order flow information. In the meantime, there are a lot of other brokers who charge you some commission fee. These are more traditional brokers, and then they promise you not to dual trade. So what do we mean by dual trade here? The definition of dual trade is basically about whether the brokers use your information very, very strategically to make a profit. Because we know that regular brokers also trade on the order flow information to break even. So the combination of the other brokers and, these other traditional brokers who charge you some commission fee but don't dual trade really resembles the closed auction in our setting.
So Jiaheng, go ahead, Albert.
Oh, just a quick question. This is wonderful work, and you got me very excited to learn more. One thing that about the model, you seem to not have a selection of clients into banks or the exchange, meaning that maybe these banks, Morgan Stanley and others, they might prefer to have clients that are a bit less informed than the rest of the market. And so the composition of the flow that then enters the bank versus the exchange is different. And that might be an endogenous part of the model. Have you thought along these lines?
Albert, I have to say that's a very great comment. Currently in our model, we do not have endogenous selection of the traders, whether they trade in a bank or in closed auction. We kind of just model it in a very exogenous ad hoc way. But that's certainly one direction that we'll go after. It's difficult, and we certainly want to go toward that direction. Thank you.
Okay, thanks.
Yep.
Quick question.
Yep.
It's Yanbing from University of Florida. So when you define guaranteed close, do you define the guaranteed close as the one like between 4 to 4:10 p.m.s with the same closing prices?
Oh, yes, that's a great question. So that's how we measure guaranteed close. I'll get to that very quick. But you're right. That's how we measure guaranteed close volumes.
Okay. The other question is when you're saying there was a D flow D orders that was 20%, when is that? Like the most recent like data actually shows D orders like increase almost like 50% or more than that. So the pattern you saw probably because the people actually bankers or broker dealers actually shift their market on close orders or limit on close orders to D orders, because D orders you can place the order regardless of the initial order balances, like what's the direction of the buy or sales. So most people try to camouflage their tradings and place the orders in the D orders, and the D orders is like 5 minutes later than the initial market, the cutoff for the MOC and LOCs. So I just wondering if they actually use the closing auction orders, D orders in rather to close that is after markets.
Yeah, thank you. That's a really great comment. So the 20% number on the closing D order, if I'm correct, I think that's the December 2018 data. So I'm sorry that doesn't capture the recent growth in the closing D orders. And in terms of, we certainly need to control for the closing D orders in our empirical analysis. We haven't done that yet, but you're right, we have to do it. And then, but later, we will see that how that affects our empirical results that currently I'm showing you, because basically we use kind of a different diff strategy, and then the policy shock, which is the New York Stock Exchange fee cut that happens in the beginning of 2018. I'm not sure if there's like a huge difference or huge growth in the use of closing D orders around that particular time period.
But for the regulation change around 2018, one thing you omitted is actually the D order is still the lowest prices. The fees charging to the D order is actually 0.05 cents compared to like 0.08 cents that was a charge on the MOC or LOCs. So maybe that's the reason why even it's like the broker dealer or banks are fee sensitive to the changes.
I see. Sorry, I didn't know that. So, and thank you for bringing it up. We will check later how that affects basically the plausibility of our study.
Yeah, thanks.
So I have a question as well, Jiaheng.
Yeah.
A bit related to Albert, but on the empirical side. So you showed us that the guaranteed close attracts a lot of uninformed trading, and I believe in that. But it's not surprising because we've seen in other papers that the closing auction in general attracts a lot of uninformed trading. So will you be able to tell us if the guaranteed close has a lot of uninformed trading relative to the closing auction?
That's a great question. I don't think we have that kind of analysis so far in this paper, but presumably we can try to measure the amount of informed traders and liquidity traders in both the closed auction and the guaranteed close, and then that will be a useful statistic, I think. Our model so far does not really rely on which side has more informed orders or liquidity orders. And and similarly, that doesn't affect the interpretation of our empirical results. Our empirical results is very simple. It's just to show you that the price informativeness kind of improves. But you are right. In order to understand the mechanism behind it, it's important to know that the fraction of basically informed and liquidity traders on both sides. Thank you for the question. Yes.
Yeah, if the guaranteed close has more uninformed trading than the closing auction, then that would be a way to understand your bottom line result, I think.
Yes, thanks. All right, so here's the literature. We basically contributed to 3 strands of literature about close auctions, dark pools, and due trading and backrunners. Due to the interest of time, I have to skip the discussion of the literature. Here's the roadmap of the rest of the talk. So first, I'll show you empirical evidence that guaranteed close improves price discovery. And then I'll talk about our very stylized model and the equilibrium. And then I'll show you our model's prediction, which is that the guaranteed close will improve price discovery based on our model. So going back to an earlier question, how we measure the volume that happened in the guaranteed close. Exactly, we kind of think that the guaranteed close volume is almost equal to the off-exchange market on close volume. Of course, there's some measurement error here. Some of the off-exchange market on close volume may not be the guaranteed close volume. We are kind of confident that in the time period that we study, starting from 2016 to 2018, anecdotal evidence told us that it is mainly these investment banks who are conducting guaranteed close that are offering these off-exchange market on close values. But of course, there may be measurement error. And then how do we measure the off-exchange market on close volume? We basically measure them by all the trades in TAQ that are not canceled or corrected and occur basically in a 10-minute interval after 4 p.m., after the market close. And in the meantime, they have to happen as the official market close price determined by the close auction. We use this measure based on SEC Division of Economics and Research Analysis Department's report. Well, the researchers of this report basically verified all these trading volumes and trace them to the original orders and find out that indeed these volumes were triggered by the market on close orders. And our focus is the period of beginning of 2015 to the end of 2019.
Can I ask a question again? Sorry.
Yep.
Can I go back to the 3? Yeah. So I think like there was 2 like type 1 error and type 2 errors when you're using this method, because like between 4 and 410, if the stop price doesn't move very much, especially for the illiquid ones, then you identify a lot of false positive ones. On the other hand, like there was a lot of orders that actually happened at 4:30, 5:30. That is also exactly the same closing prices, and the trading volume is actually huge, and that must be coming from, like, say, bankers and broker dealers. And I think the way you can identify them is actually using the trading report facility with the flag of PEG orders, the PAG orders, because like I think the CBOE market close actually they're saying if they have this guaranteed closes, they will have the flag with these PEG orders. So you can overcome the type 2 errors in that sense. But there was like type 1 and type 2 errors, both using this method. That's my thoughts.
I see. Thanks for the suggestion. Yeah, I didn't know about the TRF data, but we certainly should check that out. Thank you for the suggestion. All right, so now I want to introduce what is this regulation that we use in the definitive strategy. Basically, we used the New York Stock Exchange close auction fee cut in January 2018. What does this fee cut do? This fee cut applies only to market on close orders. And basically the intention of this fee cut was actually to just bring back some of the orders that are now went to the bank. The exchange wants to bring them back to the exchange. So what the exchange does is to cut the tier 1 rate by almost 42% and cut the tier 2 rate by again, almost 40%, and cut the non-tier rate by 9%. What are the tier 1, tier 2, and non-tier rates? Basically, tier 1 and tier 2 rates are applied for these kind of broker dealers who trade a lot, really a lot, in the closed auctions. And we think that because of that, these fee cut regulation has differential effect on different stocks. So it is the stocks that are really heavily traded in the closed auctions, presumably because they have higher like ETF and index funds ownership. It is these stocks that are more affected by these fee cuts. That's how we define our treatment and control group. Basically, we rank the stocks by the average fraction of closed price volume that are executed in the guaranteed close, and the treated groups are the stocks that rank at the top 50%. The control group are those ranked at the bottom 50%. You see that the treated group stocks are larger in size, and then they have higher ETF and index fund ownership. And now, given this designation of treatment and control group, we still need one price informativeness measure. So here is our measure. Our measure is the mean squared error between the market close price and the next day's open price. And we scale this mean squared error basically by the market close prices itself. The purpose is to bring this mean squared error measure into the space of returns, kind of, so that it is more homogeneous across all the stocks. And this mean squared error measure is calculated every month. This mean squared error measure is the same measure we used in our model, and we're following June 2014 paper. What's the identifying assumption of this exercise, empirical exercise? We kind of need to assume that the overnight news shocks are similar between the treated and control groups. We don't want it to be the case that we find that the fee cut affected the mean squared error of the treated group stocks more than the control group stocks, just only because the treated group stocks has like maybe larger overnight news shocks than the control group stocks. So what we do to mitigate these concerns is that we put in a lot of control variables that I'll get into in the next slides. And then also we show that our results are robust to including or excluding the earnings announcement days. So these are the days where you experience a lot of news shocks overnight. And all our results are robust to use in the last 5 minutes VWAP and last 15 minutes VWAP as a denominator to replace this close price as a denominator. So this is our standard definitive regression formula. And what are the control variables we put? We put size, the total trading volume, the fraction of closed auction volume as a fraction of the total volume, and basically the amount of total retail volume, as well as total institutional volume, and et cetera, et cetera. Importantly, we control for the volatility of the stock. This is intraday volatility during the market hours. And we also control for the overnight beta. How is this beta calculated? Basically, I regress for each stock the overnight returns on the overnight market returns. This is to control for the risk exposures overnight.
So Jiaheng, given that this is your key regression, I guess,
Yep.
The mean squared error, right? Can you go back one slide? How do you so is it essentially the overnight return that's in the numerator?
Yeah, so basically it's you can think of it as an overnight return squared.
But how can we distinguish two types of price changes? One that's transient and one that's permanent, because you could have a lot more effect on your numerator, but it could be for either of two reasons. It could be that there was a lot of transitory price changes because of liquidity demand, or it could be a lot of information and then it's going to be permanent changes. So somehow, I guess one wants to know which of these holds, and you want to use some future price to distinguish between, so much in the spirit of the spread decomposition models that we have that try to separate permanent impact versus transient impact. It's key because your focus is on informativeness. It's not a side issue, I think, here.
Yes, I think that's a good suggestion. So yes, we will have to think about it and then try to incorporate that. Thank you.
The fees that you're testing, historically, the listing exchanges have had a monopoly on closing auctions, NASDAQ and NYSE, and BATS put in a proposal to the SEC to compete. And actually, in January in 2018 is when the SEC actually permitted it to happen. And then I think the other exchanges appealed the SEC's decision, and the SEC didn't overturn it. And I don't think BATS ever got any volume, but I think the NYSE most likely reduced the fee in order to preventively prevent the volume from going over to sharing it with BATS.
Yeah, that's a good mentioning. So first, I think you're right that the NYSE and NASDAQ, they are not only basically targeting the volumes at the guaranteed close, but also trying to prevent the volume going to things like other exchange competitors like BATS. But if I remember correctly, the BATS, CBOE's BATS exchange were launched in the early 2021. So that doesn't affect the validity of our definitive regression results, if I remember correctly. But I will double check. Thank you.
No, I just mentioned it in the context is one way to make sure that the volume doesn't move is to reduce the fees.
I see.
You might be able to get a sense by looking. I haven't looked at it recently, but look to see how much volume is occurring in BATS is close. I checked a while ago and there wasn't anything there, surprisingly enough. But
yes, that's a good question. It's actually on our to-do list. We haven't done it, and I apologize for that. And yeah, thank you. All right. So now I want to show you basically the first stage of our definitive regression. I show you, so here I'm plotting the definitive regression coefficients, showing you the differential effect of the NYSE fee cut on the guaranteed close trading volume between the traded group stocks and control group stocks. So you see indeed that the traded group stocks, they were initially increasing compared to the control group stocks in the closed auction trade volume. But then right after this fee cut, the trading volume for the traded group stocks at the guaranteed close declined substantially. This serves the first stage of our regression. And then the next plot is showing you our second stage. So what this does is to plot the definitive estimated coefficients on the effect of the New York Stock Exchange fee cut on the mean squared error measure of our price informativeness. So you see that the traded group stocks and the control group stocks kind of share a parallel trend before the fee cut, but then right after it, the traded group stocks experienced a large increase in the mean squared error, basically the square of their overnight returns after the fee cut. So it means that the price informativeness of the traded group stocks actually deteriorates. So that gives our conclusion, which is the guaranteed close actually improves the price discovery at market close. So now I want to show you basically in another format of the results that you already saw in the plots. So here I'm showing you a few different measures, basically these are variants of the mean squared error measure. We kind of use different prices as a denominator to scale the mean squared error, this stuff, and then also the median of the squared error, and also the mean of the absolute deviation. Basically, it's the absolute value of the overnight returns that's in column 6. All these measures point to the same conclusion, which is that after the fee cuts, the mean squared error of the traded group stocks increased, meaning that the informativeness of these traded group stocks declined. And then what are the column 7 and column 8? These are our placebo tests. Basically, we want to show you that the fee cut does not affect the intraday volatility and the intraday average spread of the traded group stocks differentially than the control group stocks. Because the volatility and the spread are measured intraday during the market hours, they shouldn't be affected by the fee cut. And indeed, you see that they are not affected. Let me comment also on the magnitude of this, the effect of the fee cut. Basically, the increase in mean squared error is almost equal to about 16% of the sample mean of the mean squared error. So another thing we did is to match samples, basically match the treated group stocks with control group stocks that are similar on a few variables. So these are the variables we use. Basically, we match on size, match on total volume, we match on intraday volatility, and we match on overnight beta. The purpose of doing this matching is really to control more explicitly for the overnight news shocks. And then this table shows you the results coming out from this matched definitive regression. You see that the coefficient estimates of the effect of fee cuts declined a little bit, but they are still significant. And our placebo test results also hold as well in column 7 and column 8. Let me again comment on the magnitude. Basically, the increase in mean squared error for the treated group stocks is about 12% of the sample mean of the mean squared error. Now, with the rest few minutes, let me basically briefly go through our model. Our model is very stylized. There's a single asset that pays a dividend V, which is normally distributed. There are M uninformed traders and N informed traders. And there's a competitive market maker. Each trader buys or sells 1 unit of the assets if she participates. Basically, this is the unit demand assumption. And each informed trader receives a signal, SI, individual signals, and the convenience cost of trading at the bank, gamma I follows the distribution GU for liquidity traders and GX for informed traders. This convenience cost basically determines who will trade at the guaranteed close and who will trade at the bank. It's very, very exogenous way. The bank also submits orders to the market maker on the exchange, and then the market maker sets the close price P. The market maker will set a fee phi M, which is exogenous. We take it as given, and then the bank will set a fee which is phi B, and we solve for it endogenously. How do the traders choose the values? So the trader will trade with the bank if its convenience cost is lower than the basically what we can gain from the fee differences by trading with the bank. With this exogenous distribution assumption, we know that alpha, which is equal to G phi M minus phi B. So basically, alpha fraction of the liquidity traders will go to the bank in equilibrium, and the theta fraction of informed traders will go to the bank in equilibrium. And then how do they send orders? The liquidity traders' net orders to the bank and the market maker are distributed normally, respectively. They have kind of different variance determined by the fraction of liquidity traders at the bank alpha, and then the remaining fraction, 1 minus alpha, happen at the market maker's place. The informed traders buys and sells only if it finds that buying or selling conditional on its own signal will give him an expected profit that's higher than the fee that's incurred by his trade. We impose some distribution assumptions in order to arrive at this intermediate result, which is that the net total informed orders X is linear in the true value of the asset V, so eta times V. And then eta is related to the number of informed traders, N. It also is related to the basically the precision of the informed traders signals. So with all this, the informed traders' net orders to the bank and the market makers are expressed in these ways. This is basically a plot to summarize our model. It's very simple. There are some informed traders, there are some liquidity traders, and theta fraction of informed traders go to the bank. Alpha fraction of liquidity traders go to the bank. The bank receives the orders, and then the Y, which is the net orders from both traders. And the bank will trade, send orders to the close auction based on this Y. So the bank will send Y, which is their received orders, and adding its own hedge position, D, which is function of Y.
So excuse me, I've got a, if I may, so why would an informed trader sign a market on close deal with the bank? It seems like if I'm informed about fundamentals, I would want to trade at the lower prices. Let's say I want to buy, I would want to front load my trading before you know, prices get pushed up because of this information.
I see.
So for example, I might want to trade a T-Wop or something, or I might trade the first half of the day if I think information is about to come out and I'm informed about this.
I see. That's a really good comment. We have to admit that's a drawback of our model. We only model like the close auction is like a 1 period thing, and we do not allow the traders to trade ahead of the close auction. But we are considering really to extend the model to also include the regular trading hours things and how traders basically split orders during between the regular hours and the close auctions, et cetera, et cetera. Yeah, thanks for the suggestion.
So I think even if that's the case, if they select out of the closing auction, I think there's still order flow information that the bank might have, but maybe the channel is not information, but it could be something like inventory management, because they have a better sense of where the imbalances is going to go at the end of the day. Just food for thought.
I see. Yeah, thanks. Well, then to close the model, the close auction market makers on the close auction receives the net orders from the traders directly, and also it will receive orders sent from the bank, and then the market maker will set a price. So we solve for the bank strategy. Because the bank strategy is to maximize, the purpose is to maximize its own expected trading profits, conditional on the net orders it receives. And we also impose a linear equilibrium. Basically, we impose that the market close price is linear in the net orders received by the market maker in the close auction. We also impose that the bank adopts a linear strategy. So here is our equilibrium. Here you see that the price of the stock is linear in the net total orders received by the market maker on the close auction. Also, the bank's trading strategy is linear as well, pinned down by this K parameter. And eventually, lambda, the price impact parameter, is a function of K, the bank's strategy, as well as other parameters. So I will emphasize that the bank absorbs half of the liquidity orders if it does not receive any informed orders. And then the bank's trading strategy K has the same direction as basically the difference between the informed trades and the liquidity trades. Eventually, we reach our conclusion. Basically, it is to say that having the bank to conduct the guaranteed close will improve the basically informativeness of the close price. We measure it by the scaled mean squared arrow, and you will see that mean squared arrow scaled by the variance of the asset value sigma squared is reduced to a very simple expression, 1 over Kasai. You can interpret Kasai as kind of the signal to noise ratio of the trades. When there's no bank, the signal to noise ratio is lower than when there is bank, because the bank effectively amplifies all the informed orders. All right, with all that, let me conclude. Over the past few years, the rise of index funds and ETFs really increased the end-of-day trading volume. The closed auctions held by the primary exchanges became very expensive, and then the banks kind of started to provide liquidity. We show you quasi-experience evidence that guaranteed close improves price discovery, and we build a Coauthored model to interpret the empirical findings. We hope that our results have implications for US nowadays brokerage industry. And thank you very much for all your comments and your attention. Thank you.
All right, thanks a lot. We have 10 minutes left until the official end of the seminar for more questions. And then, of course, if questions extend beyond that, Jiaheng has said that he's happy to stick around and field more questions afterwards. Albert, I see you've unmuted yourself.
Yeah, one thing, I mean, and this is wonderful topic and good to start thinking about it. One thing that I simply fail to understand is, can you go back one slide?
Yes.
So in this equation right at the top, when the price gets, let's take the polar case, the price is like super informative, so it's actually V, then the mean squared error is 0, right? So
Yes.
you seem to talk about in the empirics about the mean squared errors being larger as evidence that prices are more informative. Did I miss something? Whereas this suggests that they would be less informative if the mean squared error is larger.
So here, the P is not a static thing in the model. We kind of, our model will kind of predicts a distribution of P depending on V. So we kind of want to compute how far is P from V on average, kind of over time. So it's like an average measure. And at any specific point of time, P does not equal to V.
Correct, but would you agree that if it's on average closer to V, prices are more informative?
Yes, that's right. So mean squared error is lower, then the price is more informative. That's right.
Oh, okay, maybe I misunderstood your conclusion. So I think in the empirics, you had the conclusion that mean squared error went up.
Oh, yes. Yeah, sorry about the flippings, because so our regulation shock is to reduce the volume happening at the guaranteed close. And then the result of that is an increase in mean squared error. Meaning that the price,
I got you.
Yeah, so
I got you.
have to
Okay,
flip
no,
it.
this was a bit confusing. Okay, I'm good. No, wonderful, thanks.
Thank you.
Do you have any evidence on the volumes? I don't think you showed us that today. So, so your main result, what the independent variable, where the left-hand side variable is volume. Do you have results on that?
Yes, it's not in the table, but I just flashed through in this figure. This is the volume. This is the volume happening at the guaranteed close, and I'm showing you the differential patterns between the treated group stocks and control group stocks. So for the treated group stocks, these are those, you can think of them as those have a lot of high ETF and index fund ownership. And starting from the beginning of 2015, the volume happening at guaranteed close is increasing, and then suddenly after the fee cut, it declines.
Hey, can I ask one more question?
Yep.
So do you ever consider somehow the spillover effects from guaranteed close into the continuous trading market, like the liquidity or trading volumes, etc.? Because I think the NYSE actually recently consider like giving huge discount to the market makers that actually do more closing auctions. They actually offer, if they're doing more trading volumes on the continuous market, they actually offer discount on the fees they're doing closing auctions. So I was just wondering whether you ever consider the spillover from guaranteed close on the continuous market tradings. Thanks.
I haven't seriously considered that, but that's potentially interesting. I have some results basically showing you at least these regulation shocks that induced changes in the trading volume that at the guaranteed close. These policy shocks do not lead to changes in like basically two measures that are measured intraday. These are the volatility and spread. So if this empirical exercise has its merit, it means that maybe the guaranteed close does not have spillover effects, at least to the volatility and the spread of the stocks of the regular sessions. but we haven't looked at other measures of like market performance, et cetera, et cetera. And I think with our empirical setting in hand, we can potentially investigate. Yes, thank you.
So this wasn't something that you singled out as a result, but it seems that your model would also make a prediction about how guaranteed close affects liquidity in the closing auction. And I guess I'm wondering if that's right, if that would be a prediction that comes out of your model, and if so, if there might be a way to test that empirically.
That's a good suggestion. We haven't considered it, but yeah, we need to think more about it. Thank you. Jingxiong, maybe my co-author may know more about what the existing prediction our model has on liquidity. If he's still here, he may be able to answer the question. But yeah, we will think about it more. Thanks. All right. Hi, Albert. Oh, sorry, I couldn't hear you.
Now, can you hear me?
Yes, yes.
Yeah, okay, great. I wanted to perhaps reiterate a previous comment, but if you have three prices, the price before the close, the closing price, and the next day's open, and you want to say that the informativeness of the closing price has improved, there are a couple of different ways of formulating that theoretically. One would be to assume that the three prices kind of form a martingale, so that the increments are uncorrelated. And then the idea that there's more informative market close would mean that the variance of the difference between the close and the price before the close goes up, but the variance between the close and the price after the close, the next day's open, goes down. Okay, so that's one way to define increased informativeness. But if you're thinking about just the ability to make arbitrage profits by a market maker, then what you're looking at is whether the market maker can make a profit by, let's say, buying at the close and then either selling at the price before the close or selling at the price of the next day's open. And the profitability of that trading strategy is somewhat correlated with the correlation of the price changes. You know, you've got the two changes, the change between before the close and then after the close, the next day's open. If those changes are correlated, then that suggests there's a trading profit to be made from trading at the close by a market maker. And that trading profit may not be what I would call increased informativeness, but just the efficiency with which market making is allowed to occur on the close. So I think previous comment was making this point, but I would suggest making that distinction in the paper and telling us which kind of improvement is occurring. Is it the autocorrelation type of improvement, or is it the moving the variance through time type of improvement?
Thank you, Albert.
Hi, I'm Mina. I want to ask a very ignorant question. I thought I thought you were doing something very interesting, but I couldn't get the model. Maybe you didn't have enough time. Can you, if you can, like just explain intuitively, like what is the mechanism? Like how is this case sign affecting price informativeness? And what are the incentives? Is the liquidity playing any role? It looks interesting. I want to understand, but I think if you can explain more intuitively, that might be very helpful.
So yes, absolutely. I apologize that I just went through that super quickly. I think so the main intuition of our model is that the bank will basically trade in the same direction as the net orders it receives. If the bank thinks that the bank observes like the higher fraction of the informed trades compared to the market maker on the closed auction. So if the bank thinks that he has kind of some information advantage, he will kind of trade in the same direction of the net orders it receives. And then the result of this trading activity is that it effectively amplifies the informed orders. that are eventually received by the market maker. And this result actually relying on a crucial assumption, which is that we assume that the informed traders does not incorporate the bank's trading strategy. So there's no like feedback loop in our model. We assume that every traders have like a unit demand. That's why the effect of the bank's trading strategy on the eventual price informed is survive eventually. Yeah, thanks for the question.
And so what does market maker do? Do they take that into account and like set the price impact accordingly?
Yes. The market maker takes into account the bank's trading strategy, and the market maker is trying to break even.
So it's just really the simple idea is that banks take advantage of the information of the customer, so there is more information. So the noise trade, they just hedge. So that's just and for some due to some assumptions, the liquidity channel doesn't, or the strategic mechanism doesn't completely make this effect disappear.
Yes, that's a very fair comment, and our model currently is very stylized. And
no, I didn't mean it as a criticizing.
No.
Criticism. I just wanted to understand. I think simple intuition is good. It's just once you understand simple intuition, we can think about how to relax this assumption. But if I didn't get that, it's just hard to know. But it was useful. Thank you.
Okay, thank you.
So I just want to interrupt to say that we're now at the top of the hour. So this is the official end of the seminar for anyone who needs to leave at this point, but we can stick around and continue to take questions afterwards.
Hi, Thomas.
Hi there. Let me lower. So just a quick clarification question. I'm wondering what kind of mechanism you have in mind, meaning how do investment bank guarantee this this price on close? And I would like, for example, to have a look at fail to deliver to know if they actually trade and if that moves, if there is a link between the fail to delivers and this amount of market on close. And I'm also wondering if there could be a reverse effect where with the fee cut, suddenly investment bank change the way they provide the market on close, this guaranteed market on close, and they may end up actually trading more on the closing auction. And so that will modify your ratio, but because of because of the numerator, but because of the denominator, because of the amount the investment bank will trade on exchange at the auction.
I see. Basically, you're saying that after the fee cuts, the investment banks they know that there's a fee cut, and then the investment banks may also trade in the closed auction kind of differently than before. That's a good comment. Yeah, I think our model kind of takes into account the effect of the fee change on the bank's trading activity. But I need to double check. Yeah, thanks.
All right, last call for questions. All right, if not, let me just thank our speaker one more time for a great presentation, and I hope to see most of you back here in 2 weeks for the next meeting of the Microstructure Exchange. Thank you, and have a great rest of your day.
Thank you, Josh. See you.